Now to the discussion on the rules governing retirement accounts that we mentioned earlier in the program. The White House, through the Labor Department, is expected to announce proposals that will tighten retirement account standards and close what some see as loopholes in existing laws that allow brokers to skirt, in some people's view, their so-called fiduciary duty. Will this help or hurt investors? Kenneth Benson is president and CEO of the Securities Industry and Financial Markets Association. He opposes the change in the rules, but Micah Hauptman, a financial services counsel with the Consumer Federation of America, is a supporter, and Michael Farr is back with us. Welcome to all of you. I know this is going to be a lively and interesting conversation. Kenneth, let me start with you. If I really read between the lines of your group's position, you seem to be saying that if brokers are required to put their clients' interests first, those brokers will not be able to stay in business and will not be able to serve clients. Have I got that wrong?
Really, what you have here is if the DOL goes forward with a rule like they tried to do in 2010 and establish this new standard, then you would have to move these accounts from a traditional brokerage account where most people have their accounts in a commission-based account into a wrap account, a fiduciary account, which is more expensive. So what would happen is for the higher balance accounts, they would be paying more for services they don't want to buy. And then the real problem becomes on the lower balanced accounts. And by volume, most IRA accounts are in lower volume balanced accounts. Those don't make economic sense to put into a wrap account at any fee, so they really would be left without any access to any advice. They would be left on their own. So that's really what the problem is with the proposal as we know it from 2010.
You say this would be, these charges would be higher cost accounts. I'm curious about that because it would seem to me that what this rule would be aimed at doing would be to avoid the higher cost accounts that sometimes get sold to retirement account owners. You see what I'm saying there? They're driven into high commission accounts or accounts or to funds, for example, that have higher expenses.
Well, it's first of all a very competitive marketplace, but keep in mind on a commission-based account, you're paying a commission on a transaction-by-transaction basis. On a managed account, where this would drive many accounts into, you're paying an annual fee, which over time is far more expensive. And you're paying for services that, people do like managed accounts where they're getting an ongoing service, where in many cases a discretionary account where the advisor is making trades on your behalf, as opposed to a buy and hold account where the investor has said, look, I want to buy this stock, I want to buy these funds, I'm going to hold it for a long period of time, I just want to pay for the transaction.
Mr. Hauptman, why don't you jump in here and tell us what you think. Would it raise costs to go to this standard to the point that many would not be able to afford it and that many brokers would be driven out of the business?
No, and Mr. Benson gets a number of things wrong. So first, we have a retirement industry in which financial professionals are allowed to hold themselves out as trusted advisors, but not comply with the standards that traditionally apply to those in a position of trust. So you have largely brokers who are allowed to steer their clients into high-cost, low-performing investments that don't serve their clients' best interest. They serve the financial advisors. They make the financial advisors a lot of money. And that's because the rules that apply to retirement investment advice haven't been updated in 40 years, and they don't serve the modern financial landscape. And so they don't apply to rollovers, to IRAs, and it costs investors a lot of money. And the academic evidence suggests that the conflict of interest advice costs retirement investors anywhere between $6 and $17 billion a year.
So basically, what you're saying, if I'm understanding you, correct me if I'm wrong, Mr. Hauptman, is that the advisor can't wear two hats. He cannot be a commissioned salesperson and also have the client's best interest at heart in all cases. It just doesn't work.
No, that's not what I'm saying. And so Mr. Benson said that commissions won't be allowed. That's just not true. The DOL, first of all, hasn't proposed a rule, so any analysis about what the DOL rule is going to look like or the impact that it's going to have is just speculation. We want the DOL to propose the rule, to update it, to close loopholes in the rules so it reflects the modern financial landscape and that investors are better protected.
I want to bring in, forgive me for interrupting, I want to bring in Michael Farr, who is in this business. He advises clients. He's a money manager. I do not know, but I assume you follow what is known as the fiduciary standard. Michael, jump in here and speak to the guests.
Tyler, I think it's ridiculous that we're still having this debate. I think it's ridiculous that the securities industry has been able to protect and maintain a suitability standard as long as it has. The difference between a fiduciary and the suitability standard on, as an example, on a mutual fund purchase, when a broker recommends a mutual fund, all it has to do is be appropriate for that client, that a conservative growth fund is okay for that client. He's not required, or she's not required, to recommend the lowest fee fund. So I could, if I'm a broker, all I need to know is that fund's suitable, and if it has a 4% load charge fee as a part of it, I can recommend the one with the load rather than the no load. That's a suitability standard. As a fiduciary, as a money manager fiduciary, I have to recommend the best deal for the client. And if I am telling the client that I'm going to give them the advice in their interest, I think I'm obligated to do that. I don't know how the industry has maintained this position of a suitability standard this long. I think it undermines the credibility of the industry. And I agree with you, it does put you at a conflict of interest when you are there to give the client advice and you're trying to recommend something that's going to pay you better.
I want to get back to Mr. Benson. You get the last word.
Well, great. Well, first of all, let me say, first of all, it's a mistake to say that this is an unregulated area. This is one of the most highly regulated areas of finance. There are different channels by which customers get products. There are different channels by how they're regulated. And the brokerage side is the most heavily regulated channel there is, with the greatest redress opportunity to the client. But the most important thing is the customers, the investors, have been choosing with their feet, and they overwhelmingly choose the brokerage model because it is more cost efficient to them. And so they want to be able to buy the service they want.
All right, gentlemen.
And this rule is not going
to... Gentlemen, I've got to leave it there because we're out of time. I think our Facebook page is going to light up on this. Mr. Benson with SIFMA, Micah Hauptman with Consumer Federation of America, and Michael Farr. We'll come back to this, I promise.